Eric, welcome to Face.
Hey Dale, can you hear me all right?
Got you loud and clear, Eric.
Great.
Someone needs to stop sharing their screen so you can. I'm really looking forward to. There you go. So if we're going to show anything, Eric, have you been in Zoom before?
Uh, I think I got it.
Yeah, it's that green button there. Okay.
Let's see. Can you
Oh,
see my
yeah, got it.
coincident economic trends here?
Yeah. So this is a great time because I went to your website and you think we're nearing an inflection point. But before that, can you tell us a little bit about how you got involved in doing this type of analysis and, how your journey began as a market analyst? It looks like you're an economist. So tell us about. Was it something you always wanted to do, or was it an accident? How did it happen for you, buddy?
Yeah, sure. So I mean, it was a passion of mine for a long time. I studied economics at New York University, and
Okay.
right after school, I jumped straight to the buy side, and I went to work at a quant fund in
Hmm.
Midtown, trading fund traded equity derivatives. And it was a little bit outside of the area of my study. This fund wasn't particularly focused on economics at all. It was all statistical analysis, but it gave me a great chance to work on some of those programming skills, some statistical skills. So in the background, while I was there for a couple of years, I was continuing my economic research and implementing a lot of these statistical techniques that I was learning. Did a lot of work on long-term secular economic trends and debt deflation. And I married that with some shorter-term research on what we call cyclical economic trends. So after a couple years of doing this work in the background, I decided to leave the fund and start publishing this research on my own. And I quickly gained a pretty good following of market participants that found value in these long-term and short-term economic trends and how they relate to asset markets. So
Okay,
that's
so
how I
people
got
could
going. And it's
actually,
been over
th-
5 years now.
okay, so does this give you, this kind of information gives you a bias and a narrative to trade off of? Because, I've talked to Jack Schwager and, fundamental research is great, but it really doesn't tell you where you're wrong. So, the risk management part, what's actionable about even short-term industrial production and the consumption and adjusted real income? How do you apply that to, say, for example, what's happening in the markets right now, making new record highs? Had a nice break last week and threatening again to make another high, stalling out here. How do you apply it to the market?
Sure. So with economic analysis, there's a couple things to consider. First is that you can't go shorter than a 6 month time duration if you're trying to use economic fundamentals to help you, because anything shorter than that doesn't give economic fundamentals a chance to play out. So you have to extend your time horizon a little bit. And for
Okay.
me, the shortest window of time that I play in is that 6 to 18 month window.
Okay.
And the reason that that's important, and these indicators on the screen are important, is because asset markets, whether it's specific asset classes or sectors, have radically different performance when the growth rate of these indicators is trending higher and when the growth rate of these indicators is trending lower. And what I mean by that is we can combine these four indicators into one composite. And
Okay.
that composite is basically our outline of the economic growth rate in the economy. And you can see here how the growth rate for quite a while was trending straight higher. And around April, the growth rate pivoted and it's now heading lower. If I extend the chart a little bit, you can see the black line, how it tracks real GDP growth and how it moves in cycles. There's
Yeah.
periods, there's 6 to 18 month windows where the growth rate is trending higher, and there's 6 to 18 month windows where the growth rate's trending lower. There's obviously oscillations in between, but we're only concerned with the 6 to 18 month trend.
Well,
And what
maybe I
we've
finally, excuse me, maybe I
Sure.
finally met somebody that could explain to me, well, I'm sure why we've had dramatic performance in the S&Ps and NASDAQ, and since the time frame you mentioned, April, the Russell 2000 has gone nowhere, sideways, hasn't made a new high since that time frame. Is there something there that you're seeing fundamentally, economically, that would explain the underperformance of mainly domestic stocks here in the U.S. and regional banks?
Yeah, so I actually wasn't going to bring this slide deck out, but since we're going here, I think this is really important. So, um, along these economic trends, what I was
All right,
saying
you
before.
have to do a new share, Eric. I just see your name
Oh,
up there.
okay.
So
I'm sorry about that. Let
it's
me.
okay,
Uh,
live
I
TV.
think we got it now, right?
Yeah, there you go.
Okay, so
Okay.
so these economic trends, when we study them, there are these 6 to 18 month windows where the growth's accelerating and the growth's decelerating, and we can block these windows off. And what we know is that if we go back over the last 25 years, you could see here we've blocked these windows off to when the growth rate's accelerating
Yeah.
or increasing, and when the growth rate's declining. And we can break these periods down. And when the growth rate is trending higher, the S&P has an average annualized return of almost 20%. And when the growth rate's trending lower, the return is just about 4%. And we can go through every single period here. The power of this is it carries to different asset classes. So same thing, but for bonds, when the growth rate is trending higher, bonds
Right.
don't perform as well. And when the growth rate's trending lower, bonds perform very well. So taking that one step further to the question that you asked, and actually the lead into our interview, one of the panelists was saying we have this new burst of volatility. Well, what's actually happened? What's the fundamental factor that's changed? Over the last 2 months, we've had an inflection in growth. We've gone from a period where economic growth is increasing to a period where now economic growth is going to start decreasing. And that comes with a shift in what have we been seeing? Radical outperformance of bonds. We've seen
Yeah.
underperformance of stocks, but more under the surface, to the question you asked, when growth's accelerating, cyclicals perform well, small caps perform well, the Russell performs well. And when the growth rate is coming down, when the growth rate's decelerating, all of those cyclical sectors, those regional banks, the Russell 2000, those perform worse. So that is why we've had this sudden change of market leadership and performance. There's a fundamental factor behind it. It's not that the growth rates tick down for a month or two. It's the market starting to realize that we're now going through what's likely to be a 6 to 18 month period of growth coming down.
Okay. And so the stocks in the Russell does this speak more to the US, and the other indexes are, multinationals where they can get their growth outside of the US, plus a weaker dollar would help their cause, and the Russell doesn't have that advantage?
Well, what we see is that the U.S. is such a driver of global economic growth that the strength of the U.S. dollar relative to other currencies tends to be very correlated to this growth rate cycle. It's very difficult for the United States to be in a period of declining growth and have the rest of the world have accelerating growth. If the US is declining, most likely all of the industrial economies that support US consumption are going to have declining growth as well. So when we go to these periods of declining growth, it's counterintuitive, but the US dollar tends to strengthen. So that's why when we have periods of declining growth, international actually start to underperform because the dollar tends to rise during these periods of declining growth.
Okay. So with your forecast, does this mean that the dollar, you're constructed the dollar for the next 6 to 18 months?
That's right.
Okay. And and bonds. So, everyone's talking about inflation, commodity prices have, we've had bull markets in commodities, and you can't go anywhere now. Well, at least we can go some places right now. Everything costs higher. Are you still one of the few deflationists out there, Eric?
Yeah, so last time I was on, I outlined my long-term disinflationary thesis, my long-term thesis on why the growth rate in the economy was going to continue to come down. But my shorter-term cyclical forecast, as you see in this chart, was that we were going to see both growth and inflation increase. That's what the leading indicators were saying.
Okay.
That now we've pivoted to, we're still in a long-term disinflationary trend, but now we're going to start to see the growth rate and the inflation rate over the next 6 to 18 months coming down, not going up.
Okay. So some of the moves in commodities for vis-a-vis lumber, giving back 60, 70% of its advance, and crude oil, WTI, cracking in the last few weeks. Is that confirmation
Well, all
for,
of those trends are entirely consistent with a growth rate that's coming down. If you went back, go back to the other slides that I was showing, the performance of assets during these upturns and these downturns, industrial commodities, as you might imagine, perform really well when the
yeah,
economy is accelerating and perform really poorly when the economy is trending lower. So this
okay.
inflection point that we've had at April or May, it's been a major inflection point in growth, as you can see in this chart. So there's a fundamental factor behind all of these sudden shifts that we're seeing in the market. It's not happening by accident. It's coinciding with a regime shift in the rate of direction of growth.
Okay, and growth is a lot of people feel the reopening trade is still alive and well. They're saying Delta is not going to be a problem. What do you say to people that point towards the consumer being in great shape, having banked a lot of this uh, aid money, some of them have, and their balance sheet has never been better, which is going to fuel consumer spending. What do you have to say about that?
Okay, well, there's a few things I want to say about that, and this relates to one of the things that we were talking about in the lead-in as well, which is the Fed. So this is real GDP, and the green line is the trend line in real GDP prior to COVID. So the
Okay.
economy was growing at about 2.3%. That was the trend before COVID.
Okay.
Then COVID happened, GDP declined sharply, and now we've snapped back. And this dotted line is where the economy is expected to be after Q2. So the red line will be one full year from the low. And what we know in economics is there's a rule called the Zarnowitz rule. And what that tells us is that sharp or deep recessions are followed by sharp recoveries. So the deeper the recession, the sharper the snapback. But the severity of that snapback only occurs in the first year.
Okay.
Then the cycle owes you nothing less. Then you start to revert closer to trend growth. So all of these crazy outsized gains we've made in the economy, the historical research shows that happens in the first year, which is what we see on the chart here. Now we're going to have to grow, or we're going to start to revert towards trend. And what we see is that if we're going to close this gap by the start of 2023, which is only 6 quarters away, we're going to have to grow at a sustained pace of almost 4% for the next 6 quarters. And for a variety of reasons, which we may not have time to get into, that's extremely unlikely given that our prior trend was only 2.3. So what that means is we're going to have a persistent gap. The space between the green line and the blue line is a gap in real GDP, and that's a disinflationary gap. And that shows that the consumer or the economy as a whole hasn't recovered to where we were. And the reason that the market, or specifically the bond market, started to freak out and flatten, the yield curve started to flatten when the Fed made their slightly hawkish move a couple weeks ago, is because the market realized that the Fed was going to be tightening monetary policy with a GDP gap, which is a major problem. They're going to be tightening or stunting the recovery when the recovery hasn't fully caught up to where we were prior to COVID. So when the market pulled that rate hike into 2022, we saw a rate hike built into the curve at the end of 2022. That was the market saying that the Fed was going to raise rates before we've closed this GDP gap. And that's why there's been a significant flattening, and there's been all kinds of reactions to what people think is not a very hawkish Fed, but the economy still hasn't recovered.
So, I mean, it seems like, Powell has, been on both sides of the fence on this. And, since his last statement that, we are going to have to taper, has kind of been walking it back a bit. Do you think he's going to follow through with the taper? I've talked to some people that think he may start sooner than the market is anticipating year end, but that it could happen sooner, um, maybe next month. What do you think? Is Powell going to be more concerned about his legacy or being renominated as Fed chairman? I
You
know
know,
that's.
if
Go
it
ahead.
comes to be a political decision, it's a tough call. So, I can't say which month he's going to start, but what I can say is that any act that shifts in the direction of tightening will be incredibly short-lived and will be reversed quite quickly, particularly if the tightening comes while we have an existing GDP gap. That's going to add disinflationary pressure on top of disinflationary pressure. So the secular or the long-term trends in the economy, pushing growth lower, pushing inflation lower, pushing interest rates lower, those trends are so incredibly powerful that I know that as soon as he moves in the direction of hawkish, we're going to see a reaction in the bond market like we saw, flattening of the yield curve, and that's going to have spillover to all of the other cyclicals. So any tightening action that they take will be very short-lived.
Okay. Well, there are people that believe that um, he already has by, I believe, raising the Fed funds rate, 500ths from 0.00 to 0.05, and that the banks are having trouble with too much liquidity. They can't keep all the cash on the balance sheet, and that's why they keep doing what we used to call match sales, and they call reverse repos now. Any comment on that?
Yeah, so I don't view it as a tightening. I think it's more of a technical factor to try and avoid the appearance of negative rates, because short-term interest rates probably would be in negative territory already had this
Okay.
had the reverse repos not been available. But basically, what's happening here is through fiscal stimulus and through quantitative easing, we're uh, flooding the banking system with deposits. Uh, Fiscal stimulus and QE both increase deposits in the banking system. And those deposits generally flow into two places. They can flow into private sector loans, or they can flow into securities and cash assets like reserves or repo and things like that. The loan to deposit ratio shows us that while deposits in the banking system are going up, loans are not.
Yeah.
So the banking sector
Contracting. Yeah.
the banking sector is not taking these new deposits and putting them into new private sector loans, which would increase the velocity of money, GDP, all of those things. What they're doing is they're taking the deposits and they're just redeploying it back into various securities, agency securities, treasury securities, and all that's doing is it's keeping the money, it's trapping the money in the financial system. There was this theory before COVID, is that the reason that QE didn't work is because it wasn't QE for the people. Well, if we send checks to people and we do QE, that'll increase the velocity of money because we'll send money to people with a high propensity to consume. Well, we did
Right.
exactly that and velocity went down. And it has nothing
Yeah.
to do with the shutdown because velocity is lower today than it was in Q2 of 2020. And nobody could tell me the economy is not more open today than it was in Q2 of 2020. So there's
Great
something
point.
fundamental going on here where you can send people money. It can be in their bank account, but that check that appears in your bank account is a deposit in the banking system. And that deposit is not, the bank's not taking that deposit and directing it towards a new private sector loan. They're just taking it, giving you zero and redeploying it into a security and making very little. It's a free spread, but that's what
And
they'd rather
consumers are
do.
saving and paying down debt instead of spending.
Yeah, that's right. That's right. So
Okay.
one of the things that we can
Where's the
see
growth going to come from? Is the question, right? And
that is the question. So this chart here, what's called the marginal revenue product of debt, it basically tells us how much GDP are we generating per dollar of debt. And this is government
wow.
debt, household debt, corporate debt, and
Yeah.
financial debt. And in the 1950s, every dollar of debt was generating about 70 cents of growth. Today, every dollar of debt's generating about 26 cents of growth. So as we continue to try and use more debt to solve a problem of over
A
indebtedness,
debt problem.
we're getting
Yeah.
diminishing marginal returns, and
Right.
that's putting us into a downward spiral in economic growth that we won't be able to get out of, because the political, or the probability of reduced spending or austerity on any level in a modern democracy is quite difficult. So we're probably going to continue to go down this road of increased indebtedness on top of a existing debt problem. And a lot of people believe that that's going to lead to inflation, but really it leads to disinflation or deflation.
Okay. Very interesting, Eric. Does China come into play? Because your earlier statement that, if America's not performing, it's kind of like if we catch a cold, the rest of the world catches pneumonia. But I do recall in the Great Recession, China wasn't as affected by it as much as we were in Europe. And, economists were hanging their hat on that China was going to lead us out of that bottom. And China, I believe, has problems of their own that might be kind of similar to this. So you can't have it both ways and say China could pull us out of something, and then if China's having problems that it's not going to hurt or bother the U.S., where do you come down on that?
So China has two major problems, and going forward, they're not going to be the engine of growth that they were. Two problems. One is that they have a major population bust,
Yeah,
especially over the next several years, because of the one-child policy that they implemented. So we know that trend economic growth is a function of population growth and productivity growth. Their population growth is going to start contracting. I believe it actually private research shows that it actually may have even contracted last year. But their population growth is going to be a problem for them, and it's going to be a problem for the engine of the world going forward. The second
okay.
problem is the productivity of their debt. So if China decided that they wanted to build a city of 1 million buildings, and they were going
Which
to
they've
use debt to
done.
fund it, which they've
Yeah,
done, of course, that's going to increase the price of commodities around the world. I think they heard a statistic that they poured more concrete in a 3-year period than the US did over 100 years. So that level of demand, that outward shift in demand, of course, is going to inflate the whole world. However, that debt, those projects were unproductive projects, because they either are, a lot of these infrastructure projects are not
yeah.
generating any cash
Ghost
to
cities.
right. So
Yeah.
so this curve, this marginal revenue product of debt, this curve is actually even worse in China, because the use of their debt has been more unproductive. If you hire
Interesting.
a bunch of people to dig a hole and fill the hole, technically that adds to GDP. Government spending is a line item in GDP, but that doesn't increase the standard of living of the people as a whole. So that's going to register as an increase in debt and an increase in GDP, of which that debt increase generated a lower and lower amount of GDP. So you're going to need larger and larger and larger stimulus packages, infrastructure packages to generate less and less growth. And that's the direction that the US is going, China's going, Japan's going, and Europe's going. All of those major economies basically make up all of the world's growth. So the world is going to move into this really, as we saw in the last economic cycle, but it's going to be even worse this economic cycle, this continued slow grind. And when I make that point, I just want to caveat that this is not a doom and gloom forecast. I don't say this to suggest that there's going to be some major crash or some major explosion. I actually don't think that's the case. I think that the most likely path is a slow grind lower to lower rates, lower growth, more death by 1,000 cuts versus some super explosion.
Okay, and are you recommending larger allocations to the debt markets, to sovereigns, to and uh, and less exposure to equities? Would you be changing that?
So the way that I think about asset allocation is that when economic growth is accelerating, so when we're in a
Hmm.
trend of rising growth, you want to have more equities than fixed income because equities perform
Right,
better. And
right.
your equities, you want to be tilted towards your cyclical exposures, your materials, your financials, your industrials. Now we're moving over to the right side of this screen where growth is going to be decelerating, or the economic growth rate is going to be coming down. So that means you're going to want to shift, like you said, more towards fixed income, more towards long duration, and your equity exposure, this exposure that you do have, you want to tilt that defensive, like large cap tech, utilities, healthcare, consumer staples, and you want to start to avoid those cyclicals, those industrial commodities, things like that.
Okay. And the high yield junk market, HYG, should that be giving us a signal that things are happening by, I know there's some Fed influence on it after COVID, but HYG, is that an indicator for you, Eric, that you pay attention to
I don't
the
follow it.
spreads?
Yeah, I don't follow it as an indicator of where we might be going, but I would use it as a confirmatory signal. So the fact that
Okay,
we are in an environment where growth's slowing now, I would expect HYG to start having worse performance than it's had over the last 6 to 8 months.
okay. So, do you have subscribers, retail or institutional, and how do people follow your work? I actually have a request, Anthony Aldridge. Yes, there will be a copy of this recording. It will be on Twitter. It will be on our website, and I'll give it to Anthony too. So this is it. This is your contact
Yeah,
information.
so I have both retail and institutional clients on my
Okay.
website, EPB Macro Research. I publish a lot of research and blog posts for free. I publish a lot of stuff I'm starting to publish more stuff on YouTube.
Okay.
And for those that are interested on epbmacroresearch.com, I have both a monthly report that I publish, which covers the leading indicators of that short term cyclical trend that we talked about, sort of
Yeah.
discussing where the growth rate is going to be heading. And then I also have a quarterly presentation which I go through the long term, the short term, kind of the whole package once a quarter. So
Okay.
that's kind of what I provide, and this is where you can find me. I'm really active on Twitter, so that's a good
Okay.
place if you want to interact.
Eric, thank you so much. And do you spell Zarnowitz? This is for my copy, Zarnowitz.
That's right.
Okay, so I learned about Zarnowitz as well as many other things, and I appreciate your work and that you're giving spirit to come and share your work with us today for our community.
No, thank you
And
for sharing your platform. It's really
all right,
appreciate that.
everyone, you can follow Eric on right here on Twitter at EPB Research and check out his videos. And if you want to be in touch with the fundamentals of what Eric is talking about, he's very good. And I learn every time I talk to you, Eric. Thank you very
Thank you.
much.
Thank you very much.
Okay, so that's a wrap, everyone. We'll see you tomorrow. See you, Sinatra. Remember, don't just count your economic indicators, count your blessings, and we'll see you all to wrap it up. You're very welcome, everyone. Thanks
Thanks.
again, Eric.